So we are going to start today with block 3. I hope the screen is visible to everyone.
Yes, the screen is visible.
Okay. So block 3, it is related to financing decisions, and the financing decisions are related to financial markets, sources of finance, capital structure, and leverage analysis. So we have to go through 4 units in this block, and when we start with the first one, that is financial markets, all the other 3 components, that is sources of finance, capital structure, and leverage analysis, this all are related to the funds that are raised from the market. It talks about the composition of debt and equity, how we decide which type of funds has to be raised from the market, and when we look into the factors of raising fund, the components on the basis of which funds are raised, we need to understand the market of those funds. So the funds from where we can easily avail the sources of finance is your financial market. Like every other market where we have buyers and sellers, same way we have a market for financial assets or instruments, also for financial products and services also. But the financial market is not a market made up of bricks and mortar. It is an invisible market, a virtual market. We don't have a physical existence of financial market. It is only in the provisions, it is only in the concept. So when we talk about financial markets, it is a place where the exchange of goods and products which are done, it is of financial in nature. The involvement of funds is an important component which is there in the financial market. The second part, that is unit 9, it will be the sources of finance. Now, in the financial market, what is available? All the sources of finance, all the products of finance. So, for one company, for one investment, for one investor, debt, that is debenture, or long term fund can be a source. For another company, it may be only equity shares. For another company, it may be preference shares. So there are different components of sources of finance, and looking into the characteristics of each and every source of finance, looking into the paying capacity, looking into the efficiency of each and every company, the sources of finance are decided. From the sources of finance, we are directly linked with capital structure. Capital structure is the composition of your owner's fund and borrowed fund. When we talk about owner's fund, it is the fund which are raised through the issue of equity shares and preference shares. Borrowed fund, they are the funds which are raised from the market, and then we are compelled to pay interest on borrowed fund. Even in the case if there is a loss, the company has to pay interest every year, and this is a statutory obligation for all the companies to pay interest on time. So, depending again on the nature of the company, on the size of the company, on the performance of the company, on the age of the company, on the profit earning capacity of the company, the capital structure of a firm is decided. Capital structure is the total of all the funds raised from the market, maybe through owner's fund, maybe through borrowed fund. And the last one, it is leverage analysis. Leverage analysis talks about use of more and more depth in the business so that we can have trading on equity. So trading on equity means leverage. And leverage means use of more and more debt in the fund, in the business, use of more and more debt fund in the business, so that who are the beneficiaries, so that the equity shareholders are benefited by the use of more and more debt in the particular company's capital structure. Why we say more and more use of debt? Because it is going to compensate the rise in the cost of capital of equity shares. It is a often believed that it is a general belief or the perception of the market that debt is available at a cheaper cost when it is compared to the equity shares. So when debt is available at cheaper cost, in that case, people want to avail more and more debt source of finance in the business, and after paying the fixed rate of interest on annual basis, the balance is enjoyed by the equity shareholders, and this whole process or phenomena of the use of debt and gaining from the balance is known as leverage or trading on equity. So this is the brief introduction of block 3, financing decisions. We know we have four type of financial decisions. If you remember, the four types of financial decisions are: the first one was investment decision, second it is financing decision, third it is liquidity decision, and the fourth one is dividend decision. So we are done with investment decision in the block 2, where we came to know which type of investment we should make. When we make an investment, we need to compare the cost of capital with the return on investment. We aim at minimum cost of capital and maximum rate of return. We aim at optimum capital structure, a balanced capital structure. What is optimum or balanced capital structure? The capital structure through which we have to pay less for the cost of capital and maximum benefits can be derived through return on investment. So this was all about your investment decision. We had gone through different techniques of evaluating a particular investment proposal, and from the available alternatives of evaluation, from the available alternatives of investment proposals, through the techniques and tools of capital budgeting, we can select any one. There may be few businesses, there may be few projects which may be mutually inclusive. So that also we need to analyze and then apply the tools and techniques of capital budgeting. So this was all about your investment decision, which is already done in your previous class. The next part of your financing decision is your decision related to the raising of funds. It is the decision on the basis of which you raise funds with the use of various sources of funds that is available for a particular business. And then when we identify the sources, we try to explore the sources, we try to analyze the nature of sources in terms of cost of capital. So this is what we will be starting with financing decision. I hope the concept, the introductory concept is clear to everyone. If you have any doubt in the concept understanding, what we are going to have today as block 3, you may ask. Do you have any doubt in the concept that what we are going to discuss today? My dear learners, you need to reply to
No,
me.
ma'am.
It's only Usman who is in the class. I hope
No,
there are
no.
10 others.
No, no,
It's
no, we're all
you.
listening.
Yeah,
Okay,
not
thank you
yet.
so
We'll
much.
ask as we go on.
It's
Okay, okay,
clear.
thank you. Thank you so much. Sometimes night is very monotonous if I cannot listen to your voices. So I keep on asking, please respond. So don't take it otherwise. I know each and everyone is listening to me.
Okay.
Sure.
Thank you so much. So the first one, it is financial markets. What we are going to study in this, the significance of financial market, the role of financial market, the importance of financial market, how the financial market operates. We need to compare the different market participants, that is the components of financial market, or else we can say the players of financial market, and the different types of financial market, their features, that is their nature, characteristic, and the purpose or the objective of their establishment. So we will be having it divided into 8 sub chapters. Starting with the first part, the introduction to the concept, introduction to the financial market. So, already explained what is a market. It is a place where the buyers and sellers meet, and what is the objective of coming together at a particular place to exchange goods and services or financial products and instruments for consideration. For a consideration means against the exchange, against the payment in terms of money. The markets further are classified as product market, factor market, and financial market. So, product market is a place where goods and services are traded, any type of goods that we consume. Factor market, it is a market where the factors of production are available. Factors of production, it may be your labor, it may be your capital, it may be your land, it may be your managerial skills, it may be your machineries. And the third type of market, it is your financial market, where your financial claims are traded. Financial claims or financial or the sources of finance are traded. So for our subject matter, we're not going to study the product market, because that is a market where you are going to study in the subject marketing management. So, product factor market, it is a subject matter of production management. For us in financial management, we will go through the financial market. So, financial market, it is a system of processes and functions that are usually regulated by means of rules and guidelines. So, we are dealing with money, we are dealing with financial products, financial instruments, we are transacting in terms of financial considerations. So, the market is very crucial for promoting the economic efficiency. Now, when we talk about how does this market functions, it is a very easy concept. The market functions by linking up link of they try to link the buyers and sellers of financial products. Now, when we talk about linking the buyers and sellers of financial products, it means they try to link the savers and investors. Savers, those who have excess of financial considerations, and investors, then those who are using the saving amount into some productive purpose. So, in financial markets, financial assets such as shares, bonds, they can be sold and purchased. They facilitate the flow of funds for financing, and then they, by investing this into different agencies, the how this flow of fund is facilitated, the flow of funds is facilitated by different agencies. It can be households, it can be firms, or it can be government agencies. Now, what is the role of this, role and functions of financial market? So we know that financial market, it is a place or a mechanism where we bring the funds or savings, and then this savings are transferred from surplus units to deficit units. So, for an example, I have amounts which is in surplus. I have savings after meeting out all my expenditures. Then also I have certain amount as savings. The savings are with me and it is still with me unless and until I go and put it in some financial institution or deposit it in the bank. Now, if as an individual I have savings and then I can pay or lend this savings to at a maximum my friends or to my relatives. When lend this amount to my friends or to my relatives, then that is a very small community, very small crowd. We don't know that there may be people beyond my friends and relatives who need that amount. And if my friends and relatives are not in having any requirement for the amount, then again the funds are with me. Same way, there are people who require money, who have shortage of money, funds, but they do not know where to approach. At the max, they will be approaching their friends and relatives. And if their friends and relatives do not have it in excess in the form of savings, then they're not going to get that amount. So, the financial market is a place where the savers come and deposit their surplus amount. They transform their surplus amount, their savings, into investment, and then the borrowers who are having a shortage of funds, who have a deficit of funds in their business operation, they approach to these financial institutions, they approach in the financial market, and then from there they can borrow the funds which have been accumulated through the savings of different investors. So this way the market works, and in this way the surplus funds, the savings of the surplus sector, are transferred to the deficit sector. So if you do not have a proper financial market, it will be very difficult to transfer these funds. And there will be, if there is no financial market, no option of investment, then no one is going to come for investment. So in order to have capital accumulation, in order to have creation of more and more capital in the economy, the financial markets plays a vital role. So each and every country need funds for their economic development and growth. In an economy, the funds are obtained from where? From the savers or from the surplus units, the units which have more income than their expenditure or consumption, and then they are being put into the deficit units whose consumption or investment is more than their current income. So this, in an economy, when we study the economy as a whole, the individuals, one individual sector of an economy, surplus is transferred to another economy, another individual sector of economy who is having that deficit. So this is what the finance takes place. The flow of funds from the lenders to borrowers takes place. So we have financial markets, and in the financial markets, with the use of financial intermediaries, who are financial intermediaries? Those who try to link the savers and the borrowers. They may be your commission agents, they may be your brokers, they may be your financial institutions. So this financial market, they try to provide a link from ultimate lenders to ultimate borrowers. this way, the flow of funds takes place. So, the flow of funds is ultimate lenders, it is your surplus unit, and ultimate borrowers, they are your deficit unit. You can see the arrow, financial market ultimate lenders. You can see the arrow moves to the upward direction to financial intermediaries. So ultimate lenders put their money to the financial intermediaries, and financial intermediaries take this fund from the financial market, and then they bring it down to the ultimate borrowers. Am I clear? I hope you understood this diagram.
Yes, ma'am.
So coming to the next, it is functions of financial market.
Ma'am,
Yes,
I'm asking what the difference between borrowers and lenders.
borrowers and lenders.
Yeah.
Borrowers and lenders means that borrowers are those who need fund. Am I clear? Borrowers are those who need fund, those who have deficit of fund or shortage of fund. When we borrow funds from bank, we take loans, so we are called borrowers. We are borrowing the fund from different sources. Lenders are the institutions or the individuals who have in surplus funds. The surplus is against the savings. Then they put their savings, they lend their savings to the financial institutions, and these financial institutions then they grant or they lend the money to the borrowers. Am I clear? If I have more, if I
Yeah.
have more
Excuse me,
income,
ma'am.
if I have more income than my consumption, I will be having surplus. So the surplus that I have, the balance of income minus consumption that I have, that will be my surplus. And this surplus, I will like to transform it into an investment. Because surplus is your saving, and your saving, if it is at home, it is not going to give you any interest. So we will put that money in the financial institutions, in the financial market. We can invest it into different sources. And when we invest them into different sources, the amount reaches to the financial institutions, to the financial market. There our funds are accumulated, capital creation in the economy takes place, and from this place, we are going to lend the money to the people whose consumption is more compared to their income, and that is the reason why they have a deficit or shortage of money. Am I clear, Asad?
Yes, yes. Thank you.
Okay. So now, if we start with the functions of financial market, so what are the functions of financial market? The first, we will be discussing the economic functions. The second, the financial functions, and other related functions. So the economic functions, when we talk about economic functions, we need to understand it in terms of economic objective. Economic objective where funds, transfer of funds, profits, growth, capital creation takes place. So in this, the first one is the transfer of economic resources from sellers to ultimate users. So transfer of resources from the lenders to the borrowers. Next it is, we are going to, if we go for investment, in that case, we are going to generate interest or dividend on the invested amount. So when we generate interest or dividend on the interest amount, we are going to increase the earnings of the individual. So when we have a increased earnings, this is going to directly increase the national income finally. We are using the borrowers, they're borrowing the funds for productive purpose. They borrow the funds and then they invest it in either purchase of new assets or in the expansion or other diversification programs of the business. So this way also we are going to increase the gross national products or gross income of the country. If we have excess of money, we have more money accumulated in the economy, we can go for more economic and welfare activities of the people. We can serve the society through different government programs in a more better and planned manner. And the most important objective in economic operations is that new savings flow into capital formation of a country. If we have more and more investment opportunities, we are able to attract the investors to put their amount from savings to investment. So we are going to create a flow of money in the economy. Otherwise, there will be stable, stagnant. We have savings, we have surplus, but if the surplus is not taken out from the houses, from the individual sectors, then it is of no use. So, what is important? The flow of funds, the movement of funds has to take place. And for having the movement of funds, we need to channelize the funds through proper channels. If we start with the financial functions, it relates with the surplus units to deficit unit. The units with surplus are putting their money to deficit units. So when we take the money from the surplus units, invest it, and then through those investment, the capital creation takes place, and then what we do, we lend those surplus to the deficit sectors. So what happens? The functions that are performed are, we try to provide borrowers, that means those who require funds, with the funds. The borrowers can avail the funds, and then there will be no hindrance, no stoppage of their daily activities. There might be quite possible that if they do not have proper funds with them, the production process can come to a standstill. They may not be in a position to go for more expansion or new purchase of new projects. There may be also quite possibility that they are not able to make the payments to the employees or other stakeholders. So there, in order to have a proper flow of their business activities, we provide funds to the borrowers. We also provide funds for the borrowers to have assets. When they invest in assets, the assets are used for generation of more and more profits. When they purchase more and more assets, it means that there is a demand of more and more products. So production takes place, supply of goods takes place, and the last one, the financial function, that it provides liquidity in the market. The liquidity in the market is converting the investments again into cash. First we have cash, we make investment, we block the liquidity, and then again when we go for selling the investment, then again we get back to the liquidity. So this is a process that is maintained with the help of financial market. Otherwise, who is going to repurchase our investment? So the repurchase process involves huge amount, and this huge amount is available through the financial market. If we go with other functions are also very important, like price discovery. Price discovery means the interactions of buyers and sellers in a financial market. When we have the financial products exchanged at large numbers by the buyers and sellers, so the price is determined on the basis of demand and supply of financial products in the market. Liquidity already discussed, and reduced cost. If we have more buyers and sellers, we are informed about the transaction cost. We know how the money has to be circulated, how to purchase the financial asset. This all helps us in reducing the cost. If there are less numbers of buyers or less number of sellers, that is less number of borrowers and less number of investors, in that condition there is quite possibility that the market is monopolistic, and demand and supply is not the reason of price determination, but it is the monopolistic approach which is going to decide the prices. I hope I am clear till this.
Yes, it's clear, ma'am.
Okay. Now this is
Yes,
a
it is.
flow chart. This is a flow chart of the financial market. Just you, before I start explaining, just you go through this flow chart. Read each and every sub component of this market, flow chart of the market, then I will explain. Just read it. There is no requirement to understand. Just go through the terminologies that is used in the boxes. Gone through it? You
Yes,
can
ma'am.
take
Yes.
another
Yes,
minute's
okay.
time. Then I will explain the components. So you all belong to African countries, everyone?
Yes, ma'am.
Yes,
Okay.
ma'am.
So what,
Yes.
like in India, we have a central bank as Reserve Bank of India.
Yes,
What
ma'am.
is your country? What is your country's central bank?
Central Bank of Nigeria.
We call it Bank
Central
of
Bank of
Zambia.
Nigeria.
One by one, one by one.
I'm from Zambia. We call it Bank of Zambia.
Bank of Zambia. Others?
In Nigeria, we call it Central Bank of Nigeria.
Okay, good. So what we are going to study now, this is related to the framing of guidelines, policies for other banks. Okay. So if we start, you can see, I will just increase the, I think font size is okay. Yes. Now you see,
Yeah, it's
topmost,
okay now. Yeah, it's okay now.
it is okay now, na? Yes. Now you see the topmost, it is a financial market. Can everyone see this? I will be little slow in explaining this. And this financial market, it is divided into two parts, organized market and unorganized market. Now, when we talk about organized market, it is a market where you have proper guidelines, proper policies. There is a controlling authority. So when we talk about authority, just now I told you, we have a central bank in each country. So this central bank is the authority or is the regulator of your organized market. Am I clear? Coming to unorganized market, in unorganized market, what happens? We do not have any proper guidelines, any proper policies. So anyone can influence such markets. We have a example of, I will first go with unorganized market. Unorganized market, we have money lenders and indigenous bankers. When we talk about money lenders and indigenous bankers, it means that money lenders, are you familiar with the term money lenders? Do you know who are money lenders?
Yes, ma'am.
Yes, ma'am.
Okay, very good. Whenever we have requirement of funds for very short period, we do not approach to the banks. We try to find someone who is very close to us. We try to find people who, without going for any security or without any formalities, are going to pay us the money. These money lenders, they're the individual people, they're the influential people who have plenty of money with them, and by lending money for a very, very short period, they try to charge high rate of interest. Am I clear? So they are not structured, they are unstructured. They may be someone who is in the business, in the market. They may be someone whom we know amongst the family of friends who are into money lending business. They give us money, they lend us money, and then after the requirement, they take the money back along with the rate of interest. The second part of an organized market are indigenous bankers. Indigenous bankers are the group of people or the community of people who are into money lending business. Now, what is the difference between money lenders and indigenous bankers? Money lenders are individuals. Money lenders are individuals, and indigenous bankers are those community of people who are into money lending business since inception. I can give you the example of India. Like in India, we have different community of people. The people are divided or used to be divided long before independence, right from British law rule, according to their type of job they do. As per in our country, there were people who are into all holy works, religious works, like Brahmins, like you all have priest, we also have. So there is a community who is always engaged into religious activities. They become priests, they do all the religious work. We have a community who is into like fighting and all, who was into war and all, who become soldiers. And we had a community also who are intellectuals, who are into business. And from this, we had a community who are into money lending business. So with the name, with the type of community they belong to, we can easily identify, okay, they are the people who had lots and lots of land, and then they were zamindars, and they were the people who are engaged in money lending business. So it's a community. Year after year, decades after decades, their family business is money lending business. But when we talk about individual money lenders, it is not like that. It may be, I am doing this business just because of gaining amount, gaining some benefits in the form of interest. Am I clear with the difference of money lender and indigenous bankers?
Yes, ma'am.
Yes, ma'am. Okay, Farida, thank you. Now we come to the organized market. So when we talk about this money lenders and indigenous bankers, they do not follow any guidelines. Okay? From me, they can charge 10% interest. From you, they can charge 15% interest. Looking into the intensity of the requirement of funds. How much intensely the funds are required. From someone, they can charge 5% also. I know you, okay, you are my friend, I will charge only 5%. So they do not follow any guidelines. And we also do not hesitate in approaching them, because we know that even if during the midnight we knock their doors for the requirement of fund, it is easily available. So now coming to the second one, organized market. Organized market is a market where, to have the funds, the first important thing is that you should have a credit worthiness. You need to produce certain documents. You need to assure, or you need to ensure that you are going to repay the amount back. You are in a position to pay the interest for the borrowed funds. So when we talk about this organized market, we have capital market and money market. When we talk about capital market and money market, the funds are available and invested for long term and short term. Short term means a market where the funds are available only for a period of 1 year or less than 1 year. And capital market is a market where the funds are available for more than 1 year. So when we make investment in capital market, it is for long term. When we make investment in money market, it is a short term. So the sources through which the investment is made in money market and capital market, they are: capital market, we have industrial securities, that means shares of companies, we have shares of government, and we can also have long-term loans from the financial institutions. When it comes to money market, then money market instruments, products are called money market. On a call, you can get the money for a shorter period of time. We have bills, we raise bills in the money market. Companies raise bills. We have treasury bill market. Treasury bill is raised by only and only government enterprises. And of course, we can also avail funds, loans for a very short period of time. Then when we come to the long-term market, in the long-term market, we have market for mortgages. Mortgages means we need to put some of our assets with the financial institutions as a security, and against that security, we can avail the funds. We can also have long-term loans against the financial guarantees. Financial guarantees means that we hold fixed deposits, we have investment receipts, we have other documents against the investments made. So these documents are kept with the financial institutions again as a guarantee. So we can guarantee either the assets through mortgages or the financial guarantees. By using the financial documents, we can avail the money. When we talk about securities market, that is share market is again for two classification. We have two classification of share market. The first is primary market. Primary market is a market where we can say that the shares are available directly from the company. When the shares are available directly from the company, the shares, there is an opening date and there is a closing date. And after the issue is closed, after the offer is closed, the shares can be traded from the secondary market, and the secondary market are the stock exchanges. The secondary market is a financial institution through which we can have the exchange of shares, purchase and sale of shares, after it is not available in the primary market. The primary market is also known as new issue market, because the shares are issued directly from the company. I hope this statement is clear to everyone, this flowchart. Whenever this question comes, the structure of financial market, you have to depict this flowchart. And on the basis of this flowchart only, if you explain the answer, it will be more You can have more marks and it will be very presentable also. I hope I'm able to make you clear.
Noted, ma'am.
Yes, ma'am.
Okay.
Yes.
Thank you. Now I'm coming to the next one. Just 1 minute. This is all I explained. What is money market, short-term market, capital market, long-term market, primary market, where first time the shares are issued, it is known as initial public offer. Secondary market is your stock exchange. Equity market is a market for equity shares. Debt market is a market for debt instruments like debentures, bonds. Government securities market, the government shares are available. Corporate debt market, it is a market where corporate debts are available. Corporate financial instruments, debentures market, bonds market. Each type of investment has its own market. Foreign exchange market for every country, where the foreign exchange rates are decided by the central bank of that country. We have a foreign exchange market. Insurance market, loan market, mutual funds market. These are different other forms of market. Who are the participants in financial market? The participants are the bank, the central bank of the country. Next participant are the commercial banks. Other than the central bank, we have the commercial banks. Other indigenous financial agencies. The discount houses from where we can get the bills discounted. Acceptance houses, where we can go for trading the money market instruments. And who are the participants of capital market? It is the banking institutions, commercial banks, then comes the cooperative banks, non-banking financial institutions. We have the investment banks, merchant banks who are not into direct banking, but they're into project counseling, they're into restructuring, issue management, portfolio management. They help in restructuring your financial structure. They provide you with working capital finance. So these are all the components of your capital market. So the first one, that is the financial markets, we are done. Kindly read this summary. It's there on the screen. Quickly read it so that we can move to the next. I'm just scrolling down. So these are the key terms or the vocabulary. I hope you are acquainted with each and every word now.
Yes, ma'am.
I'm just scrolling. You just look if any word I have missed to explain.
Ma'am, can you describe banks as money markets?
Money market is a market where we can raise the funds for short period. Short period means the period for 1 year or less than 1 year. Within 1 year, we have to pay back the investment. Okay? If we have borrowed fund from money market, within a period of 1 year, we need to pay back. And if we have invested in money market, then within a period of 1 year, we need to go for the realization or maturity of our investment. Money market is a short-term market and capital market is a long-term market. When we talk about the money market operations, it is through money market. When we talk about capital market operation, it is for shares, for securities market. Capital market is for a longer period. Long-term securities are traded in the capital market. And when we talk about primary market and secondary market, they are the bifurcation of capital market. Capital market is again further divided into two, that is primary market and secondary market. Why? The reason is because primary market and secondary market, they are dealing in long-term securities, shares.
Understood.
Good, you are asking. I'm just scrolling down, see if anything is missed.
Ma'am, just so that I get that I'm getting you clearly. The central bank, can we say
Yes.
it's part of the capital market? Am I right to say that?
Central market, no. Central bank is the bank which frames rules, policies, guidelines for money market. Because when we talk about securities market, capital market is securities market, and when we talk about securities market, then it is governed by some other regulatory authority. I don't know which is the authority for your country. For our country, it is Securities Exchange Board of India. So you must be also having, just give me 1 minute, I will search which is the agency. RBI is the bank which finances to the commercial banks. But when we talk about money market, it is the policies that is there, how to control inflation, how to control money in the economy. These are the functions of central bank. You are from which country? Zambia?
Yes, ma'am.
Okay. So for Zambia, the regulator of securities market, that is capital market, it is Securities and Exchange Commission.
Thank you.
Okay, so it is Securities and Exchange Commission, and this, it is same here also in India. We have Securities and Exchange Board of India, that is SEBI, and for Zambia it is SEC, and they are established by the act of the parliament. When we say that they're established by the act of the parliament, that means they are free from the political influences. No ruling government can influence the policies of such regulatory bodies. Every country has their own regulators, okay? So you just put that who is the regulator for securities for your, with the name of your country, you will get the answer in the Google.
Thank you, ma'am.
So I'm just scrolling down fast. We need to move to the next also. Investment companies are those companies where we make investment and then they make use of our investment into long-term objectives. Now, can we move to the next?
Yes, ma'am, please.
Now we are starting. This is a very small topic. Sources of finance. Sources of finance means that what are the different ways through which we can raise money. Okay, so these are the objectives you need to understand. The importance of sources of finance. Next, the advantages of different sources. And how this sources of finance is helpful. When we talk about the sources of finance is categorized on the basis of money market and capital market. The sources which are available in the money market and the sources which are available in the capital market. So in the money market, I already explained you can see here, it is maturity less than or equal to 1 year and capital market more than 1 year. When we talk about capital market, the market is divided into equity and debt market. Equity market is a market where we can have equity shares, and debt market where we can have other options like debentures, loans, bonds, etc. So we need to classify the sources of finance. So this is the only thing that you need to study in this. These are the different sources of finance which are available, and they have been classified on the basis of time, ownership, and sources of generation. So on the basis of time, it is long term, medium term, and short term. Am I clear? These are the different types of finances which are available on the basis of time. So if you have to decide that you require it for which period of time. Short term, I already told you, it's a period of 1 year or less than 1 year. Medium term, 1 year to 3 years, and above 3 years, it is long term. Second, it is on the basis of ownership, whether you have the ownership right in that source. So when we talk about ownership, it is through securities. And the second one, when it is borrowed fund, it is through the loans and banks. Third one, it is source of generation, from where it is generated, why you require them. So it may be internal or external. If you want internal, then the sources which are available through internal sources, and external, the sources, the requirement for external use. So these are the different types of sources of finance which is available, and then you have to go through them. Equity capital, the owner's capital, everyone knows what is equity capital. It is the equity shares. Kindly go through the advantages and disadvantages. Preference shares are also shares. They fall under the category of ownership, but the difference in preference share and equity share is that whenever we pay dividend and then we have a claim on assets, the preference shareholders are paid first, and then the leftover, the balance is paid, the residual is paid to the equity shareholders. The second important difference is that preference shareholders are paid at a fixed rate of dividend. Whenever dividend is paid, the pre-decided rate of dividend is paid to the preference shareholders, whereas the equity shareholders are paid every time according to the rate which is declared in the board of meeting. Next, we have the third category. Just a minute. Next, we have the third difference. The third difference is related to the voting rights. The equity shareholders are the real owners of the company, and so they have equity, they have voting right, and when they have voting right, they have a say in the management, they have a control in the management of the company. But preference shareholders, they do not have any say in the management of the company, and that is the reason why they are being paid only with fixed rate of dividend. They do not have any voting rights also. Debentures, when the company issue debentures, debenture is also a type of loan, but when the company seeks money through the issue of debentures, it means that the company assigns their fixed asset equal to the value of debentures issued. Suppose you want to raise money of rupees 5 lakhs from the market, so you have to assign an asset whose value is of rupees 5 lakhs, so that in case the company is not able to pay back the amount to the investors, the asset can be realized and then it can be used for the payment. Retained earnings are internal source of finance. When there is profit, we divide it, we distribute it to the shareholders, and this distributable profit which we distribute in the form of dividend is known as distributable profit. The part of profit which is paid to the equity shareholders as dividend is known as distributable profit. It is not necessary that the whole earnings of the company, whole profit of the company to be paid as dividend. You can keep a part within the company for further use. The amount of profit which is not paid to the equity shareholders as dividend is known as retained earnings. This retained earnings is also known as plowing back of profits, and this amount is used for future expansion and diversification activities. Venture capital is a form of investment where we make investment. The angel brokers, the investors make investment through equity shares so that they can become the owners of the company where the investment is made. So these are the leasing. Leasing means you are giving your asset to be used for a particular period. You are allowing the asset of yours to be used by others as a lease agreement against lease rent. Hire purchase, you purchase an asset, give it to others for use, and against that they pay you every month an installment along with the interest, and the ownership is transferred to the purchaser only when the last installment is paid. So we have different short-term sources also of raising capital. Term loan means term is period. So when loan is taken for a particular period, it is known as term loan. Now, emerging sources of finance. What are the emerging sources of finance? Asset securitization. Asset securitization means that it is a process through which an asset is converted into financial claim. That means we bring liquidity to an illiquid asset. The asset is a physical asset. The asset is a permanent asset. It has a physical existence, and that physical existence doesn't have any use. But what we do, we try to go for mortgage or keep it as security and then borrow funds against that. Example, we all know we have houses, we have assets, we have properties, fixed assets. So these fixed assets, when we need money, we keep it with financial institutions or with others as a mortgage, and against that they pay us money. So the physical asset, the illiquid asset, becomes liquid. I hope you understand. We have gold, we have investment in precious metals. So when we go and put the gold for raising funds, we do not sell it, but we put it as security and then get money against that. It is your asset securitization. And when we pay back the amount, then we get back our asset. Angel financing is a financing given to the new startup business. For the first time when business is started, the financing is angel financing. The next is crowdfunding. Crowdfunding is a very popular term nowadays. Crowdfunding means that it is a funding process through social networking. It is mostly internet based, where the startups are looking for funds to be invested by potential investors. It is a practice of raising funds using multiple websites from multiple funders. This gives budding entrepreneurs an opportunity to raise funds for their business and for promoting products and services. So the investors, they donate funds, they invest funds, and there are multiple investors for a single business. Small business credit cards. Small business credit card means that it is similar to the credit cards that we use, with a credit limit to be used in the business or for business purposes. So this is all about your sources of finance. I told you it is very easy and a very short one. So these are the terms. You just go through the terms. If you need an explanation for any term, I will explain. Just go quickly through this. I hope everyone has given your attendance. I forgot to say. I hope everyone has put your attendance in the chat box. So these are the terms. Now we are coming to the next one. The next one is capital structure. Now what is capital structure? This is the outcome. Capital structure is the outcome of your sources of fund. So we have different sources of fund, and through different sources of fund, we can raise the fund. When we raise the funds are raised with different sources. The sources may be own fund or borrowed fund. It may be short-term fund, it may be long-term fund. So what is the composition of your funds in the total capital structure of the company? It can be understood when we start with the identification of requirement of funds in the business. We may be having a requirement of funds with securities, or else we can have the requirement of debt fund. So the nature of the fund is according to the requirement. So if we start with the capital structure concept, the capital structure rule says that it is the debt to equity ratio. Debt to equity ratio means what is the mix, what is the composition of debt in the fund, and what is the composition of equity. So debt to equity is your capital structure. We need to plan the capital structure. Capital structure is planned according to your efficiency of the business. we need to analyze the profitability and solvency of the business. And on the basis of profitability and solvency, the decision on what type of capital structure company should have has to be decided. When we talk about having a capital structure, the capital structure should be designed in such a manner that it should reduce the cost of capital while increasing the market value of the company and increasing the market value of the shares. The features of capital structure. The capital structure should be designed in such a manner that it should aim in more and more profits. So it should aim at profitability of the company. Solvency, it should be designed in such a manner that excessive debt is not put into the account, into the business account, so that the solvency continues. Otherwise, if the burden of more and more debt is there in the business, it may lead to insolvency, as we will not be in a position to pay our debts. Flexibility, the flexibility means that as and when required, we can change the capital structure. Suppose we have 30% of equity in the total capital structure and 70% equity, 30% equity and 70% debt. At times, we should not be rigid that this is the fundamental principle of the company. At times, if required, it can be 40-60, it can be 60-60, even it can 60-40, even it can be 100 or 0. So flexibility in the sources of funds should always exist in the capital structure. Now, what are the determinants of capital structure? The determinants of capital structure is the leverage or trading on equity. I explained you what is leverage or trading on equity. When the shareholders wants to have more and more profit through the use of more depth in the business, we can have more depth employed in the business or in the capital structure. The second factor is related to the cost of capital. We should take care of the cost of capital. We should not go for the funds whose cost of capital is very high. We should always look for capital whose cost is minimum or low. Cash flow. Cash flow means it is a characteristic where the capital structure, there is a continuous payment. Like if you talk about debt, we have to pay interest every time, every year, irrespective of profit or loss. But when it comes to owner's fund, there we don't require to pay dividend every year if there is any loss. So we need to look out that at what circumstances, at what condition can we pay the funds. Control, of course, if you want to lose the control of the company and put it into many hands, we will go for equity shares. And if we don't want to dilute the control and we need to have it only with limited people, we will go for debt fund. Flexibility, I already explained. Marketability, we will go for marketability means we will go for such sources which can be easily liquidized in the market. Flotation cost, other than cost of capital, there are certain types of funds where the flotation cost is high, like legal cost, legal expenditure, brokerage cost, commission cost, stationery cost, the allied cost which is associated with the cost of capital. So high flotation cost, we should not go for raising funds using those sources. So this is all about your capital structure. We don't have practicals in this. It is only for understanding. We don't have capital structure theories. If there would have been capital structure theories, then 100% we would have gone for the practical aspect. So these are the keywords: capital structure, cost of capital, and financial leverage. I have explained you what is capital structure. It is the mix of various types of long-term sources of financing. It is the combination of debt-equity ratio, where we take care of all the sources available for debt financing and all the sources which are available through equity financing. Cost of capital, it is the cost. It is the cost. It is that aspect of cost which is required to raise the funds using various sources of finance. And financial leverage, it is trading on equity. So financial leverage is such type of financial planning where we try to have more and more profits before interest and taxes, and then the impact is directly on the earning per share, because the dividend holders or the equity shareholders are benefited most. Trading on equity itself means that the equity shareholders are doing trading with the use of more and more depth in the business. So this is all about your capital structure. Just read if you want to understand anything from these vocabulary words, from these keywords. Then I will move to the last aspect, that is leverage. I hope it's clear. Can we move to the next?
Yes, we can move to the next.
Okay. So this is your leverage analysis, the last unit of block 3. Sorry. So we need to understand the ratios of leverage. Leverage is what? Trading on equity. Leverage is what? Use of more and more depth in the business. We need to find out financial leverage for a business firm. We need to find the types of leverage. And when we're finding the types of leverage, we will have financial leverage and operating leverage, and the risk implications of financial leverage. Financial leverage means use of more and more depth. It is also not a very lengthy one, a small, a very short unit. What happened? Just a minute. Okay. So now I am starting. We all know what are ratios. There are 4 types of ratios. They are liquidity, leverage, activity, and profitability ratios. So when we start with these ratios, we have a word lever, and this lever word, from this lever word we have derived the word leverage. So when we talk about leverage, It means that it is a force, the action of a lever or a mechanical advantage, which is referred to as leverage. So leverage is an effectiveness or power. So when we talk about financial leverage, it means that we are using the power of financial assets so that we can have more and more profits. So when we talk about financial leverage, you see, we have we can explain, we can have an understanding of this with a suitable example. And the example is that we have earnings on assets of rupees 80 lakh at 40%. So if we have earnings of 80 lakhs, and from this 80 lakhs asset, our company's earning is 40%. So we have two options. The options are rupees 80 lakhs as share capital, and next one, rupees 30 lakhs as share capital and 50 lakh as debt. They have two alternate options of capital structure. The first capital structure is designed with 100% share capital, and the second capital structure is designed with debt and equity mix. Share capital is of rupees 30 lakhs only, and 50 lakhs is your debt. Am I clear with this concept? You understood? Did you understood these
No,
two
ma'am. Can
options?
you come again, please?
Yes, we have two
Yes,
options.
yes, ma'am.
Again, I'm repeating, we are going to find out how leverage works. I told you leverage works when we have more and more depth in the business. So we will identify it with the use of two alternative options of capital structure. So the first one, where you can see it is written rupees 80 lakhs. 80 lakhs is your share capital. So the first option, the capital structure is 100% comprised of equity share capital. The second one, the second option, it is a debt equity mix. When we say it's a debt equity mix, it means that it has debt capital also of rupees 50 lakhs and equity share is of rupees 30 lakhs. So for both the options, the total capital structure is 80 lakh. Am I clear?
Yes,
Yes,
ma'am.
sir.
Okay. Now the second option is what the question is stating, that against 80 lakhs of capital structure, your earnings are 40%. So 40% of 80 lakhs, it will come equal for both the options, 32 lakhs. Am I clear?
Yes, ma'am.
Next, we are paying interest on debt. Interest on debt means for the first option, we don't have any debt, so we will be not paying any interest. So you can see it is dash. For the second one, the amount of debt is 50 lakhs and the rate of interest is 18%. So 18% of 50 lakh is 9 lakh. So you can see in the second option, we have paid 9 lakh as your interest. Now what initially you had 32 lakhs of earnings, but in the first case you have not paid anything, so your earning remains same of 32 lakhs. But in the second case, you can see you have an earnings of rupees only 23 lakhs because you have paid 9 lakhs additional for as interest on debt. Am I clear?
Yes.
Grace, am I clear?
It's coming round, but I'll need to go through it. Truth be told.
I will just explain it. Just listen to me once. You have 80 lakhs here. You have 80 lakhs here. This 80 lakhs is a combination of all share capital. And we do not pay any interest in share capital. this 80 lakhs is a combination of share capital and debt both. So when we talk about share capital and debt, we do not pay any interest in debt, share capital, but we pay interest on debt. So what is the amount of debt? It is 50 lakhs. So we need to pay interest in the second case for 50 lakhs only. Am I clear now?
Yes, I
Yes,
think
you are clear, ma'am.
clear now. You're clear.
Okay. So we have an earnings of 32 lakhs, which comes from 40% of 80 lakhs. 80 lakh is your asset invested against the investment of 80 lakh. For when we invest 80 lakh or whatever amount, we get an income of 40%. This is the industry trend. So we have invested 80 lakhs. So against 80 lakhs, we are able to generate 40%. When it is put into amount, it comes to 32 lakhs. Now this is our earnings, 32 lakhs. In the first case, we are not paying any interest. So our earnings are intact, 32 lakhs. But in the second case, we are paying interest on rupees 50 lakh at 18%. 50 lakhs, 18% is 9 lakh. So 32 lakh minus 9 lakh, our income in the second case comes to rupees 23 lakh. Whereas we do not have any interest payment in the first option of capital structure. So the profit is intact at 32 lakhs. I hope this is clear now.
Yes.
Yes.
Okay. Now we are supposed to pay tax on our income, and the tax rate is 40%. So the first case, income is 32 lakhs. 40% of 32 lakhs is 12,80,000. And in the second case, 23 lakhs is the balance, earnings after interest. So earnings after interest is 23 lakhs, and we are supposed to pay 40% as tax on our income. So 40% of 23 lakhs is 9.20. 9.20. Now, go for balance. 32 lakhs minus tax, that is 12.80. Your earnings are 19.20 lakh. And in the second case, when you have paid interest and tax, your earning is 13.80. Now, when you compare your earnings after interest and tax, what happens? For the first case, you can see 19.20 is 24%, and 13.80 is 46%. Did you understood?
Yes, ma'am.
I will explain you. We take the earnings for shareholders. So in the first case, we have shareholders full of 80 lakh rupees. So the earnings 19.20, it is available for all 80 lakh shareholders. Now you understood? In the first case, you have all 100% shareholders. So 19.20 earnings after taxes is to be distributed amongst 80 lakh share capital. So when you compare this 19.20 with 80 lakhs, then the percentage is only 24%. It is 19.20 divided by 80 lakhs multiplied by 100. You will get the answer 24%. But in the second case, we are here not to pay the profits to the debt capital, because when we pay interest, they are out. So in the second case, we have shareholders only for a value of rupees 30 lakh. So this 13.80, which is earnings after tax, is to be distributed only amongst the 30 lakh shareholders. So when you compare this 13.80 with 30 lakh shareholders, the answer is 46%. So how much this 30 lakh shareholders are getting the profit? They're enjoying profit of 46% against their investment. And in the first case, they are getting only 25% of profit against their investment. So in which case you are getting more return on your investment? In which case the shareholders are getting more return on their investment? Can I have the answer, please?
Second case.
Everyone agrees with this? It is second case. And how it is possible? It is possible because it is a combination of debt and equity. When it is a combination of debt and equity, it is not 100% your shareholders. It is a mix of equity and debt. And when you have more income through the use of debt in the capital structure, this is known as leverage, or this is known as trading on equity. I hope I am clear.
Yes.
Yes,
Now we will take, and this is known as financial leverage. Now we will take the second part of this, where we will come, these are all the calculations. You can go through the content because I've explained you how to calculate. Now we will start with types of leverage. We have two types of leverage. One is operating leverage and the other one is financial leverage. Operating leverage, it means that it is a leverage where we take into account earnings before interest and tax. When we calculate profit before interest and tax, and the terminology that is used to calculate earnings before interest and tax, it is known as EBIT. EBIT. Capital E for earnings, B for before, I for interest, and T for tax. So we take into account for operating leverage earnings before interest and tax. So when we say it is before interest and tax, we take into account all the operating expenditures. All the operating activities are taken into account in your operating leverage. Am I clear what is EBIT? You understood?
Yes.
Yes, ma'am.
Yes, ma'am.
So it is earnings before interest and tax. Now coming to the next one, financial leverage. In financial leverage, we take into account the earnings after interest and tax. Just now, we have done that. Earnings after interest and tax, that means when we have employed additional funds in the business, interest will come only when you have employed debt in the fund, debt in the business. So when you have debt in the business and you are paying taxes, then it is your financial leverage. So EBIT is operating leverage, earning before interest and tax. And from this EBIT, EBIT, when you pay INT, when you pay INT from your EBIT, that is interest and tax is paid, it becomes earnings after interest and tax. And that earning is known as financial leverage. Coming to the next one, it is combined leverage. Combined leverage is the combination of operating leverage and financial leverage. In every business, we have earnings, operating activities also, and financial activities also. So when we have a combination of operating and financial both, the leverage calculation is calculated. That is operating leverage OL plus financial leverage FL. It is your combined leverage. Am I clear?
Yes.
Okay. Now, financial leverage and risk. How we can have risk? We can have risk when we are not having profits enough generated, and when we do not have profits enough generated, we are not able to pay the interest. And if we do not pay the interest on time, we are having a problem with the liquidity position of the company. In order to pay out the interest, what we will do? We will go for raising more funds. We will go for borrowing more funds so that we can meet the payment of interest. And in the process of raising funds and paying the short-term liabilities, we are generating more and more liabilities. And if in the long run we are not able to pay the liabilities on time, pay the interest on time, pay the principal amount back on time, it leads to financial risk, and this financial risk may lead to winding up of the business. It may lead to liquidation of the business. So this is what financial risk is, and that is the reason, though the shareholders hold and enjoy more profits, they enjoy leverage, trading on equity with the use of debt fund in the business, but it is advisable to have a balance between equity and debt. We should not increase the debt in the business, so that at times, if you are not able to pay the debts, then it is going to be a financial risk. So debt should be in such a manner, the capital structure should be in such a manner that to a certain extent we can enjoy the trading on equity, but after a certain extent we should go for equity. That is the reason why we go for a balanced capital structure, and a balanced capital structure is a structure which is not comprising of any one component, but it comprises of both debt and equity. Am I clear?
Yes,
You
ma'am.
understood?
Yes, please.
Okay. So how you can minimize the financial risk of the business? In order to minimize the financial risk of the business, we need to have a direct relationship of equity and debt. Okay. The operating leverage and financial leverage should have a proper relationship, and then only we can have the optimum capital structure. So when we have increased risk, we have to pay more interest. The cost of debt will also increase, because at the same time we are increasing the debt. So we should not go with leverage all the time. We should go for a balanced capital structure, where balanced capital structure means that we are in a safer zone. Risk is minimized. So these are the key terms for this chapter. Just go through financial leverage, operating leverage, what is leverage factor? It is the ratio of long-term debt to total assets. Long-term debt to total assets. Capital structure, it is the combination of debt and equity. And financial structure, in capital structure we do not include short-term liabilities, but in financial structure we include the short-term funds also. In capital structure we only take long-term liabilities, long-term finances, and in financial structure we take the short-term finances are also included along with the long term. Degrees of operating leverage, financial leverage, and combined leverage means that what difference it is going to make if we compare it with one unit. Okay, degree means if we want to compare it with one unit, then what difference it is going to make. Risk, you all know what is the risk. It is the risk is associated with financial risk, and the financial risk arises out of your financial leverage. Financial risk arises out of your financial leverage. Now just let me know if you want to understand anything else, or from my side for the day it is done. Anything else that you want to understand?
Yes, I have one question,
Yes, please.
but I just want to know your perspective or your own position regarding that thought. I don't know if it's related to financial management.
Can I have the question again, please?
The question, I want to know your position regarding the question. So the question is, some companies usually integrate AI, and in that process, because they prioritize profitability, they cut off their staff. So do you think that is also a way in managing your own company finance?
No, actually, when we talk about with the use of AI, we are going for retrenchment, layoff, cutoff of employees. Now, see, this is a worldwide process nowadays, laying off. Okay, and this is a very big issue, and we are trying to address this issue, but this is not related to directly financial management. Okay, so we say that when with the use of AI, we can reduce many people. We don't have to pay their salary. We don't have to pay their other expenditures. So this way we can increase the profitability of the company. So here, if you remember yesterday, we had seen two approaches of financial management, that is profit maximization and wealth maximization. So when the corporations, companies think of their own profit only, it comes under profit maximization, that they as an individual are thinking. But when we say we are going for layoff of people in the company, we are taking their jobs and they become unemployed. And this is a threat to the economy, to the country, because more and more people will become unemployed. And this is the fact with which no one can escape. Even we have so many examples nowadays, which is in limelight of Google. Google, every one fine morning or in the midnight, they just write an email and say that your services are been stopped. So this is a very big question, a threat to the economy, and all we need to overcome this threat. This is what we talk about, the challenges of technology. We are increasing the technology, we are modernizing the technology, but at the same time, we are also facing these type of challenges. Okay, you can feel the difference when we shifted from intensive to extensive agriculture. That means previously there were so many people required in offices, required in fields to work. So what happened later, when with the introduction of modern machines and all, we have replaced the people with the use of machines. Computer, take the example. That time also it was a threat to the economy, but later on we had tried to find out ways and means through which this threat is overcome. Am I clear? So this is not directly linked to financial management. This is a very important issue which is nowadays taken care by the government of each and every country. This is the evil effect of, you say, technology advancement.
Understood, ma'am. Thank you.
As a teacher, it's very highly, we are also at risk. You put any question to chat GPT and it gives you the answer. But always remember, technology is something which we feed and then the output is there. Manual feeding is from our side. If you do not feed anything in Google, that information will not be available. So, sooner or later, this will be the importance of human capital will be felt, and no, there is no replacement of human capital. So that's all from my side for the day. Can I end the class? I hope everyone has given your attendance.
Yes, ma'am.
Yes, and thank you very much.
Thank you, everyone. I hope you people are understanding.
Yes, ma'am. Thank you very much.
Thank you. Thank you to everyone.
You're welcome.